Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach. Today we have back with us Marc Vasquez, who's the co-founder and president of Donumvita, a financial education company, and today we'll be discussing the Pulley contract. Marc, welcome back to the program.
Thanks, Mike. I'm excited to be here this morning.
Yeah, I'm interested in, I always love, unique mechanisms and names, and Pulley contract. That sounds really fun. And I know in our series, we've been talking about, guiding people to a successful financial future down the road. Well, now, what's the vehicle to get them there? So give us a little bit of background on what a Pulley contract is.
Yeah, great question, Mike. I'm really excited for this segment of our series. The Pulley contract is our mechanism. It's an asset that actually helps us to help our clients close their wealth gap, to get them from where they are to where they want to be. This is the vehicle that takes them from point A to point B as efficiently as possible. It optimizes the private reserve system. It really takes into account our methodology, the stewardship paradigm. And in short, the Pulley contract is the perfect asset to help people close their wealth gap.
So when we're saying Pulley, it's P-O-L-I. Do those letters stand for something specific?
They do. Yeah, it's an acronym. It stands for Privately Owned Life Insurance Contract.
Okay.
And for those that know a little bit about life insurance, banks use life insurance. You maybe wouldn't think that they use it, but it's their preferred asset to safeguard Tier 1 capital.
Huh.
They call their contracts BOLI with the B as in Bravo for bank-owned life insurance. And the same is true for corporations. They safeguard Tier 1 capital in what they call is COLI as in Charlie, corporate-owned life insurance.
So now let me just see if I get this straight. You're working with individuals and you're going, you know what? Success leaves clues. So if you want to be successful, let's do what the big guys do. And if the big corporations and banks are putting their resources into these owned life insurance, corporate-owned, bank-owned life insurance contracts, maybe there's something to that, and let's see if we can apply that to you on a private level and give you all the benefits of what these big guys are doing.
Absolutely. So we started, this is the fourth part of a 4-part series. In part 1, I shared with your audience a little bit about how I got started, how Donumvita was founded, and I think I talked about how the Great Depression of 2009 was cataclysmic for me. And yeah. I realized that I wanted to start finding answers as to how I personally could take control over my finances and help others. And through that process, started learning that banks use BOLI contracts and corporations use COLI contracts. And so I thought to myself, I need to find out why. And so in this pursuit of finding out why, like you said, success leaves clues, I started realizing and finding out that these contracts, these life insurance contracts, provide not only death benefits, but living benefits. And the main caveat to the living benefits are that the IRS has a code called 7702. That 7702 clearly identifies what they deem as a quote-unquote life insurance policy, and if the policy is structured with the right type of insurance and structured properly to meet their requirements, then 7702 says that you can accumulate, distribute, and transfer capital within that contract on a tax-free basis.
That is probably, we could stop right now and go, hold on, done. That is, the lights now have come on. You're saying that if it's done the right way, that capital, money, accumulated and growing inside of one of these properly structured life insurance contracts can grow and be distributed tax-free. That's massive and huge, because we've talked about before, holes in the buckets. Where your wealth leaks out many times is through taxes. And if you can properly and legally and efficiently plug up as much of that as possible, well, this vehicle could be it. And I want to caution people to go, oh, cool, I heard about this cool thing in life. Okay, I'm going to go Google, get a life insurance policy. Okay, good. These are really, really specific. They've got to be structured the right way. So talk a little bit about that, because I think that now is a misconception. People go, oh, life insurance, I don't like that. But now you've got me intrigued, but it's got to be structured the right way.
Yeah, absolutely. And so I'm going to break down kind of like life insurance 101 here in as short and succinct as I can. In short, there's two basic categories of life insurance. There's term, which most people are familiar with. It offers a death benefit to the insured, to the owner of the policy, for a term of time, a specific term of time that's designated within that contract between the insured and the carrier, the life insurance company. So we're familiar most with 10, 15, 20, maybe even a 30-year contract. Now, in order to activate that contract or to have that contract in good standing, the insured, the owner of the contract, exchanges a premium in exchange for that death benefit. God forbid the insured passes away. Now, that's term. And then there's permanent. Permanent insurance means that there's not a specified period of time. Well, there is a specified period of time. It's for the duration of the insured's life, as long as premiums have been paid and the contract is in good standing. Mm-hmm. And so permanent means for the entirety of someone's life. In today's marketplace, it's common for permanent policies to cover the insured until age 100. Excuse me, I take that back. Through age 120.
Wow.
And so as long as the insured pays the premiums as scheduled in a permanent policy, it not only provides a death benefit, but it also provides cash value accumulation. And when it's structured properly, in accordance with IRS Code 7702, it will accumulate capital, it can distribute capital, and transfer capital in the form of a death benefit to beneficiaries on a tax-free basis. So those are the two specific or general types of insurance. I'm going to go back to the permanent type. And within permanent life insurance, there is whole life, there's universal life, there's a indexed universal life, there's a variable universal life. I'm not going to go over all four of those, but the Pulley contract uses whole life. Now, within whole life, there are a couple of different kinds of whole life contracts. We use whole life contracts that are issued by carriers that are what's called mutually participating. The easiest way to explain mutually participating is imagine a credit union. A credit union safeguards your money, but the credit union is owned by its members.
Members, yeah.
It's member owned. And so is a mutually participating life insurance carrier. It's owned by its insureds, policyholders. And so what that means is when a company is publicly traded, when that company has profits, those profits are distributed to the shareholders. In a mutually participating company, the profits are distributed to their members, and we call those profits dividends. And so to be super concise and precise, the Pulley contract is an overfunded dividend-paying whole life insurance contract. I know that was a lot, and I kind of opened up a can of worms, but I hope that answers your question, Mike.
Yeah, it does. And I want to make sure that one point is understood too, is dividend paying is over and above whatever rate of return your capital is earning inside of it as well, right? So if you put X number of dollars into this contract, you're going to earn a rate of return of whatever the number is, but then another way that the contract is earning you money is through these dividends.
Great point. So absolutely, short answer is absolutely yes. I'm going to use current returns, like returns that people can get access to right now. So this in 2021, there was an amendment made to 7702. In short, so these contracts have a guaranteed rate of return. Up until 2021, that guaranteed rate of return was on average 4%, and that's accruing compound interest, which is different than basic or simple interest. Wow. But guaranteed to return 4%. Now, as of 2022, guaranteed on average 3%. So if you get a dividend, right now you're realizing about 4.6% rate of return. So that's 1.6% above and beyond what's guaranteed. Because
of the dividend layer.
Dividends are not guaranteed. However, every carrier has distributed dividends for over the last 100 years. Throughout the Great Recession, throughout the Great Depression, they have been returning dividends to their policyholders. Again, they're not guaranteed, but there's not a year in the last 110 years that carriers that are mutually participating have not issued dividends.
Wow. So you mentioned a term that I want to tie back into what we just talked about here, which is living benefit. So a lot of people think of insurance as like, oh, you die, you have life insurance, so you get this X number of dollars. Well, living benefits are what we're talking about here. Living benefits with these kind of insurance contracts are giving you the benefit of cash accumulation through the guaranteed rate of return, through dividends, whatever those are going to pay. And those are some of the benefits you're getting without even having to have end of life. Living benefits today, next month, next year.
Yes. So in short, the best way to explain living benefits would be, well, I have to start off by saying that whole life insurance, permanent life insurance, dividend-paying life insurance, it is in no way, shape, or form ever considered an investment. Secondly, your premiums are being used for two purposes. Regardless of those two purposes, your premiums are considered principal. So that being said, in a Pulley contract, the premium covers the cost of the insurance, and what is left over or in excess of cost of insurance accumulates within the contract on a tax-free basis because it's considered principal.
Mm-hmm.
And if it's structured within the guidelines of 7702, you have access to the cash accumulation at any period of time. And so we call that liquidity, right? Like you have access to money. It's money that it's just money that's accumulating. It's like a savings account.
Yeah.
Except instead of earning 10 basis points, you're guaranteed to earn 3%. And instead of earning simple interest, you're earning compound interest.
And basis points, like the you said basis points and then 3%. What's basis points of 3%? Is it 300 basis points?
300 basis points, yes.
So as opposed to 10 basis points, you would be earning 300 guaranteed because of the contract. And I want to really put a pin in this liquidity, because to me that is the same difference as the word security. And I know that I spent a lot of years in the mortgage industry, and I would provide home equity lines of credit to people that had their house either paid off or almost paid off. And I would make this argument: hey, you've dumped a lot of cash over the years into your house, but if you needed that back, you can't get it. It's locked up. You got to go get a loan and qualify and cost and time. But if you have a home equity line of credit, it's almost like you're liquid again. Well, what you're saying is when you put capital, money, cash into some of these contracts, there is a way to re-access that, and it becomes liquid over time. So that's a big benefit, I would suspect.
So you just touched on an excellent point. One of the living benefits, or the main caveat of the living benefits offered through a Pulley contract, is that you've got your cash accumulation, and then you also have a built-in equity line of credit. And so what that means is, without getting too into the weeds here with the details, you've got your cash accumulation, and then you've also got what's called, every mutually participating life insurance carrier has what's called a general fund. And all of its policyholders that own a permanent policy have a equity line of credit offered to them via the general fund. And so if I want, let's say I've got $100,000 in cash accumulation, rather than take a distribution from, or a debit from my cash accumulation ledger, because remember, it's growing compound interest. And one of our principles is accrue or earn uninterrupted compound interest.
So you don't lose momentum.
How is that possible? The way that that's possible through the Pulley contract is, rather than taking a distribution or a withdrawal from your cash value accumulation, you access $50,000, in this case is just an example, from the general fund, which is collateralizing the cash value of $100,000 in your cash accumulation value. And now you're being charged, current charges are like, don't quote me on this, but somewhere around 4%. So I can borrow money at 4% all day long without taking an application. I can receive it in 3 to 5 business days. It's taken out of the general fund. And then in our last segment, we talked about this operating system, to budget, to insure, to save, to borrow, and to invest. Well, we use our Pulley contract, and specifically we use the general fund to borrow money to invest in assets that are productive. And
because in that example you gave, if someone needed that $50K, they're going to go get it from someplace like a bank, and they're going to have to qualify. They're going to have to pay closing costs or fees or higher rates, and they're going to make payments to the bank. May as well make payments back to your own self.
Exactly. And
Wow.
I mean, I could get way into detail here, but you can end up leasing. You can create contracts. Like if you're a business owner or an entrepreneur, you've got an LLC, you can create these contracts, these leasing agreements to where you're leasing money from. You're basically creating your own financial system,
Banking system
through a Pulley contract.
Yeah. I really think that's huge for people to understand that liquidity and access to their capital.
Yes.
Something else, and finish your thought there, because I want to make another point to clarify about permanent, the word permanent. So make that point you were going to make there.
Sure. Yeah. So my first question is, what are banks and corporations doing with their money to safeguard them in every phase of the economic cycle? Well, we realize that they're safeguarding tier one capital in either bank-owned or corporate-owned life insurance. Well, then the second question is, well, what are they doing? Why are they doing that? And so not only are they doing that because they have a guaranteed rate of return and it's super safe, but they're doing it for the living benefits. Well, how would a corporation benefit? Like, you're not going to, you can't buy a life insurance on a corporation. So who are they buying this life insurance for? And so the way banks and corporations use life insurance is they take out life insurance on key members of those organizations, like executives. They buy life insurance, they pay premiums on behalf of these executives, they build cash accumulation, and then as kind of a sweetener to their employee benefits, they offer them a tax-free retirement supplemental income from these contracts. And so it's a way for these corporations to sweeten the employee benefits of their executives. And so we've taken it a step further and said, well, you can use a privately owned life insurance contract to supplement your own retirement income on a tax-free basis. And so once you understand how things work, you increase your awareness, you can make better decisions, you can get better results. And so in short, people can own a privately owned life insurance contract and significantly, rather than decrease their standard of living in retirement, they can even increase their standard of living in retirement.
I just think that's so amazing for the individual, for the business. You're doing the things that the major corporations and major banks are doing out there. You're now given the ability to do it on your own. The point that I was going to make is one of the other benefits, I think, between term life and permanent, like we've been talking about, is if you have term life and it goes 10 years and it starts to expire, you got to get another term for 10 or 20 or 30 years, which means another medical check. Well, you're 10 years older. What if something medically happens and now you can't get it, or now you're 10 years older and the rates are sky high? So with permanent insurance, how does that work? Do you have to get medical checks every so often, or how does that work?
Once you're insured and once you've entered into a contract with the life insurance carrier, as long as you are paying your premiums as scheduled, after the initial process of becoming insured, once the carrier has deemed that you're insurable and you've both agreed upon a risk class, and the risk class is determined by health, in short, once that is agreed upon, that contract, that insured will never have to go through another exam for that contract. Now, if they want to purchase an additional contract, then they will have to go through what we call the underwriting process again.
Yeah, sure.
But for the contract
that eliminates a lot.
they're done.
Yeah, that's awesome. So talk a little bit here as we wrap up your mechanism of the Pulley contract. We've really polished that up well. You say that there's 3 phases of implementing the Pulley contract.
Yeah, absolutely. And it's really the same 3 phases, the way that I define generational wealth. And so for us, the Pulley contract is the perfect asset to amass generational wealth. If you remember, you asked me how to define generational wealth in one of our segments, and I think I defined it as the accumulation, distribution, and transfer of 7-figure plus wealth from generation to generation. Mm-hmm. And so the Pulley contract has a 3-phase life cycle, if you will. Phase 1 is the accumulation phase, and in essence, you're accumulating capital on a tax-free basis. And every time you make a premium payment, you're increasing the capital that is accumulating within that contract. Even if you stop paying premiums, because again, these Pulley contracts, Mike, are so customizable. So as an example, let's say I only want to pay premiums for 10 years, or let's say I only want to pay premiums for 20 years, whatever the case is. Even if you stop paying premiums, if they're structured properly, they're still accumulating capital because of the dividend component and because of the accrual of compound interest. So phase 1 is accumulate
on a tax-free basis. That's really important. Wow.
And if you think about it, that's essentially the life cycle of someone in the workforce. Everyone has a natural life cycle. There's the accumulation, the distribution, which is what we call retirement, and then the transfer, which is the transfer of legacy.
Yeah. So if you can accumulate capital, and phase 2 is distribute the capital, then phase 3 is transfer the capital. If you're doing all 3 of those phases on a tax-free basis, that's the ultimate that people would ever dream of, because taxes cut in so much to each one of those phases. And this vehicle, the Pulley contract, allows you to achieve that.
Exactly. You stated that perfectly, Mike. I want to highlight one area. We had talked about, I think, in the second series of this 4-series conversation, our mindset, our methodology, and it's the stewardship paradigm, and it's really the ethic to make, keep, and grow money. What conventional wisdom tells us, if you go to your conventional financial advisor, they're going to advise you that in retirement, the cold hard truth is you're probably going to have to live on 60% of capital that you're used to living on pre-retirement. So what that means is that you're going to be asked to willingly reduce your standard of living by 40%. Mm-hmm. We're asking people to shift their paradigm from a scarcity mindset to an abundant or prosperity mindset. And instead of saying, yeah, you know what, it's just the cold, hard truth that I'm going to have to reduce my standard of living, let's ask the question, how can we increase our standard of living? Like, you work 40, 50, 60 years to accumulate. Wouldn't it be nice to know that after whatever run you've worked in the workforce, that you could enjoy your standard of living, and it might even be able to increase? It wouldn't have to decrease.
That would be the dream.
We agree, and I don't know if your audience can tell, but when we started talking about the mechanism, the Pulley contract, I I get excited because to me it's exciting, and I want to share this information with this education with as many people as possible.
Well, I just love how we laid out the mindset and the way that you should start thinking about, your money and being educated. And then now we're landing the plane, so to speak, with here's the way to do it. And, it's not some strange, weird, newfangled thing that you got to wonder if it's even legitimate. It's the way that for hundreds of years, banks and large corporations have only exclusive to them. Well, now it's available to, and it has been for a long time, but I just think for me as a consumer hearing this, I'm hearing this as something that's a trusted, proven, tried and true mechanism, and now this is something that can benefit you on an individual basis.
Absolutely, Mike. And you've done throughout this whole series, you've kind of teed up things perfectly for me. And the last thing, I don't even know if you're conscious that you've done this, but there's one main myth, if you will, about permanent life insurance. That myth is that if you, Mike, were to go and get a quote for a term policy and then get a comparable death benefit quoted with whole life, with permanent life, you're going to notice that your premiums are substantially higher with the whole life quote. And so the misbelief or the myth is that it's more expensive and there's no value, additional added value for that additional premium. And I want to dispel that myth right now. When the Pulley contract is structured properly, not only is it accumulating, distributing, and transferring capital on a tax-free basis, but in year one, and this is huge, this is very important that your audience understands this. So if they go out and start shopping and asking someone, a broker, about the Pulley contract or how to overfund dividend-paying whole life insurance, this is the main key component. It needs to be structured so in year one, typically speaking, in year one, there's very little or no cash accumulation within a whole life insurance policy. And the reason for that is what would normally be accumulated in cash accumulation is paid to the broker in a commission. A Pulley contract is structured so that it's accumulating at least 40%, in some cases up to 60% of first year premium in year one. And so the majority of first year premium that the insured is paying into their contract is being realized in cash value. And even if someone is contributing or paying $100,000 in first year premium, they can realize about $60,000 in cash accumulation in year one. So when a broker structures a policy to really benefit the client, they're willingly taking a substantial cut in their commission. Now, that's really key to understand. And the reality is that most brokers do not know how to write contracts like this, structure them. And secondly, I'm not sure that they're willing to.
Yeah. Great point. You've got to work with someone that puts your best interest ahead of theirs.
Yes. Yeah,
Well,
we're not just asking our clients to have a prosperity mindset. We're also like this. We're looking at this as rendering asymmetrical value to the marketplace.
Yeah, putting the client's needs before yours, and that's the way you should be doing business anyway. And so, what I would just wrap up here, Marc, if someone's listening to this, going, you know what, a couple things in there you said are really interesting. I want to learn more. I want to see what this could do for me. What's the best way they can reach out and connect with you and learn more?
Yeah, thanks for the opportunity to plug Donumvita.com. That's our homepage. Just if anyone's interested in finding out more about the Pulley contract, the private reserve system, the Stewardship Paradigm, go to Donumvita.com and click Get Started, and that'll start you through our process.
Awesome. Well, Marc, thank you so much for coming on today. It was a real pleasure talking with you and learning about the Pulley contract.
Absolutely. Thank you for having me.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show or listen to past episodes, visit www.influentialentrepreneurssradio.com.